I was sent this video by a guy who trades directionally. He says that this video done by Khoo statistically proves that day trading works. And the video is called Trade Like a Casino. So I'm going to do a review on this video. So let's have a look.
Hi, I'm Khoo, and today I'm going to show you how I really make money consistently as a professional trader. And I'm here to tell you the honest truth. And the honest truth is that trading is gambling. Absolutely. The stock market is a giant casino. It's a legal casino. So let me ask you this. In gambling, who always makes money in the end? The answer is the casino always makes money in the end, right? I'm sure you've heard this phrase that the house always wins. Now, how do they do that? How can a casino ensure that in a game of chance, they always make money? And I'm here to share with you the secrets of the casinos and to show you how, as a professional trader, I set myself up as the casino. And that's how I always make money in the end. So
So setting himself up as the casino. So he obviously has an edge. Let's see what that is.
Well, what they do is they rig the games in such a way that they have a statistical edge over the market. Or they have got a positive expectancy while the player has a negative expectancy. So here's how it works. Let's take a typical game called roulette. So in roulette, what happens is you've got a giant wheel, right? And this wheel is made of numbers. And you've got this spinning device, right? Where you throw the ball and the ball will spin, you'll land on one of the numbers. And what you can do is you can bet which number you'll land on. Will it land on an odd or even number, a black or red number? Okay, so a common bet would be to bet on black or red. So for example, this is a red number, it's a black number, it's another red number, and so on and so forth. Okay, now here's the thing. Many people think that if they make a bet with the casino, they've got a 50-50 chance of being right. Well, they're wrong. It's not a 50-50 chance because the casino has rigged the game in such a way that there are altogether 18 red numbers, 18 black numbers. But there are 2 green numbers, which are the 0 and the 00. These are green. Okay? Therein lies their secret. So this is what happens. For example, if you bet on black, what's your chance of being right? Your chance is 18, because there are 18 black numbers, out of not 36, 38. Right? Because there are 18 black, 18 red, and 2 green numbers. So, and the casino's chance of winning is 20 out of 38. Because if the ball lands on the green, the casino wins as well. Okay? So if you work it out, the player's chance of making money is about 47.3%. The casino's edge is 52.7%. So what is the casino's edge over the player? The casino's edge is 52.7 minus 47.3. That's 5.4%. For example, if you got 1,000 bets and each bet is $1,000. $1 million is bet, right? $1 million bet, right? Great. And statistically, out of 1,000 bets, the casino's going to win 52.7%. The player's going to win 47.3%. Right? So that means the casino will win 527 bets and lose 473 bets. Right? Now, each time they bet, they win 1,000. They lose 1,000, right? So this is $1,000. So they make 527 grand. They lose 473 grand. Right? So this minus this is, you got it, $54,000.
Okay, so this all does make sense to me so far.
That's how it works. So now I'm going to teach you as professional traders, how do we replicate the business model of the casinos? So to most people, when they buy a stock, what's the chance of them being right? 50-50, right? It's random. It either goes up or it goes down. Now, as professional traders, we always make money at the end of the day. How do we do that? We replicate the business model of the casino. So I explained how the casinos rig the game in order to have a statistical edge over the player, right? Now I'm going to teach you how as professional traders, we rig the games. We rig the stock market. Legally, of course, right? So like I mentioned, most players, when they buy or they sell a stock, it's a 50-50 chance. It either goes up or it goes down. But as professional traders, what we do is we study the markets. We look for repeatable price action patterns, or we call it technical analysis. And by applying these price action patterns that are repeatable,
I guess he's saying, based on technical analysis, that he can predict the future. That's what I'm gathering here.
we are able to enter when the statistical edge is in our favor. Because on an uptrend, when the price hits a support level after a retracement, there's a high probability that it's going to go up.
I wonder what that probability is. Does he know that?
Now, is it a guarantee? Is it 100% it's going to go up? Of course not, right? It could still go down. But when you enter at these repeatable price patterns, the chance of it going up is more than 50-50. It's not 100%, but let's take it as a 60% chance it's going to go up. Okay? Or even 55%, whatever it is, right? Of course, there'll be a 40% when it fails and the trend reverses into a downtrend.
That stock can go down and hit your loss, but that doesn't mean that the whole trend changed. It just means that it retraced a little bit further than normal.
Okay? So say 40% you lose and 60% you win. Okay? What's your edge? Your edge is you win 60%, you lose 40%. Your statistical edge is 20%. That's better than casino. The casino's edge was only...
I really don't think he can pick a direction and choose the direction of a stock 60% of the time. Well, let's just say that he can.
5.4%, and they make billions or hundreds of millions, whatever it is, right? But as a professional trader, your edge can be 20%. Now, even if you are right only 55% of the time, some people say that's no big deal, and you are wrong 45% of the time, hey, that's still a 10% edge. So being a professional trader is better than owning a casino, if you think about it that way. Now, here's the other best part. As a casino, when you bet with the players, you're betting 1 for 1, right? If you lose $100. If you make $100. But in professional trading, we never bet 1 for 1. We always bet at least 1 for 2. In other words, we always risk 1 to make $2 or more. How do we make this happen? By placing a stop loss to guarantee how much we're going to lose and a profit target to guarantee how much we're going to win when we're right. So let me draw this again. Now, in this case, let me show another example. In this example, the market is going sideways. Usually when the market goes sideways, it's in a range. Like that, it's in a range, right? So it hits what we call resistance, support, resistance. So you have to see this repeatable price pattern. It doesn't happen for every stock. It doesn't happen every day, but when you see it, you can trade it. We only trade when...
Wait, when you see that pattern, that's what happened in the past. It could have an uptrend or downtrend after that. How do you know it's going to continue what happened in the past? Well, let's just give him the benefit of the doubt.
We see a repeatable price pattern, all right? So for example, say this is $10 and this is $15, right? So the price hits this support level and what do you think is going to happen, right? Duh, it's going to go up there, right? So we're going to buy here. Again, is it a guarantee it's going to go up? No, it's just a probability. It's better than 50-50 chance, right? But based on its repeatable price...
Actually, in my personal opinion, I don't think it's better than a 50-50 chance. But again, we'll give him the benefit of the doubt.
Price pattern say the chance of it going up is 60% chance. And the chance that after I buy it dies, it's a 40% chance. Win, lose. Now here's the difference. So say I buy it at $11. What do? I have to place what they call a stop loss order, a stop loss that says, hey, if it goes to $9, sell it immediately. I cut my losses.
What if you're holding that stock overnight and it gaps down to $8? You weren't able to cut your losses. And that is one of the possibilities that you need to consider when you're thinking about trading like this.
Right? So if you do that, how much will you lose when you're wrong? You will lose $2. So by placing a stop loss, you guarantee how much you are going to lose when you're wrong, right? And you just have to make sure that the distance from your entry price, you're buying at 11 to the top of the range, say this is 15, right? So if it goes from 11 to 15, how much you make? You make $4. So you're risking $2 to make $4. Or another way of saying it is you're risking 1 to make 2. You're risking 1 to make 2 with a 60% win rate.
Okay, right there. First of all, if you're risking 1, or let's just say you're risking $2, you're telling me there's a 60% chance you're going to make $4 and there's a 40% chance you're just going to lose $2? I'm going to go over some probabilities right now, because what options do is not only did they provide an edge if you sell options, but also you can use the deltas to predict probabilities, the real probabilities, not this 60-40 stuff that he's talking about. It's 50-50. You got a 50% chance going up, 50% chance going down. Now, because the market rises over time, it might be slightly bullish, but it's close to 50-50. But let's take a look at an options chain where the real probabilities are. So for example, here we have XLF and we have it's trading around $37.78, around $38. So if you look at the $38, here's the strike, call, the delta is around 49, close to 50, and the $38 put, the delta is at 51, minus 51. So if you had a delta at 50, that means it pretty much has a 50-50 chance of going up or down. So if we were to go down, let's say he was talking about a $15 stocks. Let's say you're going to go up $6 and take profit, or you're going to go down $3 and take a loss. So if you went down $3, that would be 1, 2, 3. Statistical probability of that is 25%. So 25% of the time you're going to take a loss. Let's see what the probabilities are of going up $6. 1, 2, 3, 4, 5, 6. Statistical probability there is 7%. Now these probabilities are based on what is going to happen at expiration or in 104 days from now. So which one's going to happen more often? Are you going to go up $6, which is 7% of the time, or are you going to go down $3, which happens 25% of the time? So you can see, if you're not shooting for a 1-for-1, then the statistical probabilities change, no matter what the charts look like.
And that's how you rig the game of the stock market. Now, if you do this consistently, in other words, out of, for example, 100 trades. Now, I do about 20 trades a month on average. So it takes me about 5 months to do 100 trades, okay? Out of 100 trades, again, my win rate is, say, 60% win rate. So I'm going to win 60 trades. I'm going to lose 40 trades, okay? Now, each time I lose $1, right? Or whatever I'm willing to invest or trade. When I win at least $2, right? Why? Because like I mentioned, we fix our stop loss and our profit target. And
okay, that's not why. That's not a good reason. His reasoning right here of why he wins 60% of the time and makes 2x and loses 40% of the time and only loses 1x. And then he says why, and this is his reason. This is not a good reason.
we only take the trade if we have a risk to return ratio of at least 1 to 2. So what happens now?
So the reason is because he only takes the trade if the risk reward is 1 to 2. That doesn't mean that he's going to get a 60% win rate on the 2 and only a 40% loss rate on the 1. Those don't correlate.
Now, okay, so I lose $40.
What's really going to happen here, actually, is you're gonna lose that $1 about 66% of the time, and you're going to make the $2 about 33% of the time. And if you run the numbers like that, here's what they are. So if you look at it, it's 33 times 2 equals 66, and 66 times 1 equals 66, which means you're going to make $66 on your wins, and you're going to lose $66 on your losses. So out of every 132 trades, you're going to break even.
I make $120. So you do the maths.
I just did the math, and it's not the same as his numbers. You actually break even.
What's 120 minus 40? $80. So I know that, you see, whenever I make a trade, I've got no idea whether it's a win or loss. In a short term, I may have a lose.
That is true. He doesn't have any idea whether it's going to win or lose, but he should know that when he's trying to win twice as much as he's going to lose, that his statistical odds are much, much lower, about 33% of the time.
Losing streak, I may have a winning streak. That's called luck. Okay, but over many trades, of at least 100 trades, for example, I know I always win because of the statistics being in my favor. I'll make $80. In other words, if I'm betting $1 for a trade and I'm betting $100, I'm getting $80 back. That's an 80% return, okay, in 100 trades, which is about 5 months. Okay, now of course there's no guarantee.
I would love to see his P&L where it shows that he's making 80% return every 5 months trading stocks. That's like making 220% approximately, somewhere around there. In other words, he'll start with 100 grand, and then by the end of the year, he'll have 300 grand. He'll have 2x his amount of money. If it was really that simple, everybody would do it.
That you're going to win 60%. Now, what if the worst case scenario happens and you get a string of bad luck, right? And your win rate only goes down to 50%.
Okay, that would not be a string of bad luck if your win rate was 50% and you were betting 1 to make 2. That would be an absolute luck streak. Well, let's see what the statistics would be if you had this super hot lucky streak.
If your win rate goes down to 50%, it means that out of 100 trades, you win 50, you lose 50, right? But because of the risk to return ratio, the way we rig the market, guess what?
Just because you take a loss at 1x and take a gain at 2x does not mean you're rigging the market, because it doesn't rig the market, because that doesn't work. That is not the secret to trading. Unfortunately, the statistics will play out. And you're not going to get a 50% win rate when you do this. I don't. Does he know this? I think he knows this. He has to know this. Either that or that doesn't really trade with real money.
We are losing $50, but we are winning double. We are winning $100. So net, I still make $50. Out of $100, that's still a 50% return. So that, my friend, is the essence of how professional traders, we rig the stock market so we always make money consistently at the end of the day. And that's how we grow our income and our wealth. Hope you enjoy.
Okay, that's just crazy. Crazy talk. Obviously, he doesn't trade like that. Because if he did trade like that, he would know right away that the statistics would shut him down and he would be breaking even. But all I have to say is, I hope you don't try to trade like this. But if you do, let me know how it all turns out for you. I'd be interested. If you're interested, I created a free proprietary options trading course, and I put a link in the description below. And hey, don't forget to hit that like button on the way out. Thank you.